In the past couple of videos, I've been explaining different trades and trade setup ideas. In this video, we're going to talk more about Rule 446. All markets are intercorrelated and interdependent. Knowing the practical application of this rule can be an absolute game changer. But first, before we get into that, let's synchronize in with the market by looking at the greatest gainers, greatest losers, and the heat map. Hi everyone, I'm Ken from Crypto Trading KS. If you're new, a very warm welcome and welcome back CTKS family. Here you'll learn how to become fearless in financial markets to assist you to become more of a financial and emotional blessing to yourself and those you love. If you like the content, please subscribe to the channel and smash that like button. All indicators that I use in the daily videos come from the service at ctksmethod.org. Let's run the numbers. When talking about Rule 446, all markets are intercorrelated and interdependent. We need to know that not all charts are created equal. The Tier 1 charts are the engine of financial markets globally. The Tier 2 and the Tier 3 charts are different. They're a little bit weaker than the Tier 1s. You'll find direct correlations and inverse correlations between a lot of these different charts. For example, as the US 10-year yield comes up, the US 2-year, we would expect the DXY to come up. As the DXY comes up, we would expect the euro dollar to decrease and also the stock market to decrease, the VIX to come up. If the VIX increases, we would expect the S&P 500, the Nasdaq, and Bitcoin to go down. There's connections and interrelationships that we can draw out that help us to figure out where the market is going. For example, if you're trading in gold or trading in silver, understanding the real yield impact, for example, inflation after interest rates, is really important. If the yields are coming up and the DXY is coming up, in all likelihood, gold and silver will go down. This is why we must understand the associations that exist between different charts. When you're applying Rule 446, it's important to understand directional correlation. Here we're looking at the S&P 500, and just since the 23rd, one thing that you will see, this interesting line, that is Bitcoin's price momentum. You can see Bitcoin and the stock market are actually moving in directional alignment with each other. From time to time, you do get lags, and this is primarily due to interdependent news, market interdependence. One market may get some really good news and another market may get really bad news. Markets are really complex. But overall, we know that Bitcoin cannot escape the stock market's gravity. Many people would think that the stock market and Bitcoin have become decorrelated. You can see here, that's clearly not the case. In understanding how all the charts intercorrelate and interconnect, you want to look for directional correlation. Here we're looking at the Aussie dollar versus Bitcoin. You can see when the Aussie dollar goes down, what's Bitcoin doing? Oh, it's going down. When the Aussie dollar comes up, what's Bitcoin doing? It's coming up. When the Aussie dollar went down, we can also see that Bitcoin went down a little bit. When it came up, Bitcoin came up. If you're trading the Aussie dollar and you see Bitcoin going down, it could signify that the Aussie dollar is about to go down. This is pretty neat stuff. Because that will impact on the DXY, you would expect the DXY to go up if the Aussie dollar comes down. A fun fact about Australia, Australia is the 6th largest landmass in the world. Aussies have been known to invade Hollywood. Margot Robbie, Cate Blanchett, Hugh Jackman, Chris Hemsworth, Nicole Kidman, Eric Bana, Russell Crowe. Those Aussies do get around. Also, the Aussies are very inventive. Did you know that an Aussie created the black box flight recorder? If you're using an electronic pacemaker, the Aussies are keeping you alive. If you've ever used Google Maps, or you are doing so right now, hey, that's an Aussie invention. In 1939, an Aussie developed the medical application of penicillin. Aussies, being very environmentally focused, created polymer banknotes. They didn't want to print that money on paper. They created the bionic ear. the electric drill, Wi-Fi technology, the ultrasound scanner. Aussies typically don't like to iron much, so they created permanent crease clothing. Just kidding about the last one. They created cancer vaccines. Mouse plagues were really common in Australia in the early days of settlement. Chances are, if you're old enough, you actually have used a mouse trap from A.W. Stanfield & Co. Yes, that's another family branch. Wes Stanfield's invention of the mousetrap was really significant for Australia. Nearly 100 million mousetraps were developed from 1943 to 2000. They were literally exported all around the world. Aussies are definitely an inventive bunch, and they love their sports. Today is really significant. It's Australia Day. So to all the Aussies watching, all I can say is, oi, oi, oi. That's just the way we say, g'day, mate. The reason that we look at directional correlation, for example, between gold and Bitcoin, when gold was coming down, Bitcoin was coming down. When gold was going up, Bitcoin was going up. Gold came down, Bitcoin came down. Gold went up, Bitcoin went up. Oh, Peter Schiff is not going to be happy. There's a lot of narratives that gold and Bitcoin move inversely. That's not necessarily the case, as we can see right now. That's why you always need to assess where charts are going from the current view. Just like the Aussie dollar, the euro dollar can give very good signals on where Bitcoin could be headed. These are things that you need to look out for. It should be part of your daily prep. What about the US 2-year yield? When the US 2-year was coming down, what was Bitcoin doing? It was going up. And when the US 2-year went up, Bitcoin was coming down. We can see there's a bit of a dilution here in terms of the relationship. You have to be aware of lags. What about the DXY? As the DXY was going parabolic, going for it, it was pushing Bitcoin down. But as the DXY decreased, we saw Bitcoin come up. Now, DXY is coming up a little and Bitcoin coming down a little. Now it's getting a little bit interesting, isn't it? Because the DXY is coming up, but Bitcoin has remained relatively constant. Why could this be the case? The FOMC meeting is in about 5 days. This is where the Fed decides if they're going to leave interest rates the same or decrease them, ease them, or increase them, do a rate hike. If a hike was the predominant percentage probability, and it's not currently because we can see the current target rate is 525 to 550, that's where we are now. The percentage probability of no change is 97.4. There's currently a 0% chance of a hike, but there's a 2.6% probability of an ease. 1 day ago, it was 2.1%. The stock market and Bitcoin, risk-on asset classes like yields to go down. Directional correlation is indeed one thing. If you understand directional correlation, you're ahead of 95% of people. But the real key is always the structure. When we look at the S&P 500, this 4894 mark has been a consistent area of resistance inside the market. The S&P 500 has tried to get out, and it's nearly made it, but not quite yet. What will happen if the S&P 500 decides to break out? This is the key question for you to answer. And I'll help you a little bit with it. If the S&P 500 does break out, we would expect Bitcoin to also break out. Bitcoin's been under severe negative price momentum. Miners have been selling. Grayscale Bitcoin Trust has been dumping. Well, more the point, it's been getting redeemed for lower value or lower cost value ETFs. MicroStrategy has been hit, as it was a very primarily the number one Bitcoin proxy. In approximately 3 months, the Bitcoin halving will be upon us. This is where we get a supply shock into the market. The supply shock makes Bitcoin more scarce and therefore drives the price up. The miners have been getting ready for the halving by just literally dumping their stock of Bitcoin to make sure that they've got the most powerful equipment that they can get to mine Bitcoin coming up. There's a lot of talk about Mt. Gox Bitcoin hitting the market. Mt. Gox currently has 137,890.98 Bitcoin. You will see so many different statistics, you must search for the right number. There's a lot of reports that have been circulating, but if you go to Mt. Gox homepage, you'll actually see the deadline for basic and early lump sum and intermediate lunch, respectively, is October the 31st, 2023, but that changed to October the 31st, 2024. According to June Analytics, the US government holds about $7.76 billion worth of Bitcoin, around 194,000. Making news today, about $130 million worth of Bitcoin is going to be sold by the US government. You can see this is not a lot in terms of their actual overall holdings. In fact, 130 million over $7.76 billion is 1.67% of the holdings of the US government, not much. No matter what you're engaged in trading and investing in, you must look to total crypto market cap and Bitcoin, especially the structural levels. Yesterday, we were looking at total crypto market cap, and we were seeing that it was trying to get above this $1.512 trillion mark. That means that it could move up really strongly into a fresh air gap and do well. What did it do? It decayed from there, found support just exactly at that structural level, and has come back up. This is not exactly what we would like to see. We would like to see Bitcoin, crypto, and all the alts just flying upwards, but you've got to take a break and a breather from time to time. This is why you need to look at that intercorrelation, and those news stories are just going around, so you need to be aware of those as well. I thought this could really help you. The Bitcoin quarterly returns are so far negative in Q1. Of course, Q1 is not over, but if Q1 was to just play out like it does on different years, what are we looking at here? We're looking at a whole year of negative. But how probable is that? Let's look back to 2018. That was 2022. Well, let's look at 2020. It went down and then 3 quarters of positive momentum. What about 2018? A negative and sort of mixed, but generally quite negative. What about 2016? Went negative, went really positive, went a bit negative, really positive. 2015, negative, positive, negative, positive. What about 2014? Negative, positive, negative, and negative. What is this indicating to us? Of course, we have to be aware of the position inside the 4-year cycle, the halving cycle. We are expecting upward price momentum, and it could be very, very powerful in this halving because we never had ETFs. What it means is we may get some negative followed by more the 2016, 2015, and 2014 price action. But it's always up and down. One thing is price is always moving in a wave. If you can ride and surf those price waves, you're going to do way, way better than you could do any other way. Let's look to a monthly basis and just remember that something going negative is not a bad thing. If you're buying on the way down, dollar cost averaging or borsogging, and the next month goes very positive, you're on the right side of the percentage. You're going to do really, really well. And when we look across all those different years, February tends to be quite a good month if we start January in a negative momentum. But to participate in a February uptick, you need to buy in January. The one thing that you want to keep in mind, what is the structure of Bitcoin? Let's pop on the indicator so that we can see structural levels from more than 5,200 days. We can see that Bitcoin is unfortunately weakening. It did look like Bitcoin was going to break out, but even if it looks like it, you know the price is always moving in a wave. You want to layer your positions down and don't get subjected to fear. When the position comes down, you're actually buying on the right side of the percentage. And when we do the percentage movements, if it comes down 50% to go back up to what it was, it must go up 100%. So the 10-5-10 rule is very, very valuable. For example, when Bitcoin was just plummeting down here, of course, a lot of people sold because they didn't know where the structure was inside the market. And I believe 2024 is going to be a very volatile year. You must know your structural levels in 2024. Inside bull markets, pullbacks of 30, even 40% are quite common. Therefore, if you don't know where the structure is, if you don't know where price can hit and get rebounded, if you don't know where strong resistance is, that is really problematic because you'll just be guessing. Also, focus on your interdependencies and intercorrelations, your directional correlations just taking into account lags. The institutional players force people out of the market by making the price go red, they're buying. Institutions pull people back into the market by making the price activity go green, that is, go up. You must not get sucked into that narrative because it's a horrible narrative. When it goes down, you sell, and when it goes up, you buy. And typically when it's going up, the institutions will be starting to dump their positions and it goes down. You'll get the death of 1,000 cuts. You don't want that. Instead, be an institution of one. Know where the structural market levels are. By understanding the rules of the market, and there are a lot of them, but if you understand them, you're going to be ahead of just about everybody else. Also knowing what particular chart impacts what other chart is really vital to your success. Have a great day or night ahead, my friends, and to my Aussie friends, happy Australia Day. And to everybody else, have a great one ahead. And we'll catch you in the next video. Bye for now.